Hi, this is Dave at AFX Search, licensed investigator. So you're buying a company and you want to do some due diligence. What do you look for? Obviously, you're going to look at financials and pro forma statements to make sure that they're accurate, the amounts are good. But then what you want to do is take it a step further and dig deeper to make sure that the sources of that income are what they say they are. If there's deposits going into a bank account, you want to make sure that those deposits are actually income and revenue from the client allocation that's been described. It's not just artificial deposits going in just to show activity. You want to make sure that if there is a book of business of clients, that they're showing retention. It's not just being churned. If all the business is just from new clients every month that take a lot of work to get them, that may stop the day that you buy that company. So make sure that client retention is there. That may come from doing some investigation of the clients covertly, maybe talking to clients about their sources, maybe having some third party approach clients just with casual conversations about where they're getting their products from. You also want to look at any variations in the past 12 months. Have there been dramatic increases or decreases in business? That might indicate that some of the activity and the picture may be distorted artificially to make that business look better for the sale. Are there employees leaving? Look at payroll records, look at census of employees. You may even want to talk to some existing employees and say, hey, who used to work here? And find some of the old employees. The best information will come from prior employees of what's really going on inside. Also, is the owner actually an employee? The owner's role is important. Many companies might show let's say a $300,000 profit. And if you're buying that company based on that profit, in the past, that profit may have been going to the owner. If the owner is doing a job that's worth $250,000, you have to hire somebody for. Either you'll have to do it yourself or you'll have to pay somebody $250,000 to do that same job. So be aware that that profit may actually be owner's employee compensation. And if you have to replace that, that's not going to be profit anymore. Are there market forces that are affecting the business? Are there changes in laws or in competition that's making that happen? Are there any big expiring contracts? If you look at all the contracts and you can look at the dates, a lot of times contract copies are provided in due diligence, but they may not be verified. The date could be changed very easily of the contract ending date or renewals. So you might want to verify that separately. You can have an investigator check that out with the cross party to make sure the contract is accurate. Asset ownership. Are the assets actually owned? If there's a construction equipment, building equipment, is it actually owned or on a UCC filing for a loan or some type of obligation due to that asset? Are the earning sources exaggerated? Meaning that if there are earnings that are showing up on the financial statement, is it artificially exaggerated because maybe the selling business cut their prices dramatically in order to get more revenue, even if they're not making profit, just to show a revenue growth, and that might be the only reason those profits are there. So some due diligence is always good. Your accountant, your attorney will give you good insight on the X's and O's, reading financial statements, looking at the numbers. But if you dig deeper than that and doing some human intelligence, talking to people, talking to clients, talking to vendors, even talking to people who sell them products, if they're selling 1,000 widgets per month, but they're only buying 50 widget parts, that might be an indicator that maybe the numbers don't add up. If you want more information or any questions on buying a company and due diligence, you can reach us at our website, afxsearch.com.